Viewers at home, you are welcome to my presentation on adjusted profit. Adjusted profit for tax purpose. This is taxation class. Adjusted profits. If you are just coming across this YouTube channel for the first time, or if you have not subscribed in the past, please click the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. Adjusted profits for tax purpose. Accounting profit is different from taxable profit. Taxable profit and accounting profit are not the same. Taxable profit is not the same with the accounting profit. Accounting profit is the profit or loss as shown in the account. The profit or loss as revealed by your income statement is said to be the accounting profit. The net profit or losses, as revealed by your statement of profit or loss. The net profit or losses as revealed by your income statement is said to be the accounting profit. It is the net profit or losses revealed by the statement of profit or loss. On the other hand, taxable profit is the profit or loss that is computed in line with the tax provision. The profits or losses as computed or that is computed in line with the provisions of the tax laws. That profit is said to be the taxable profit. I'm telling you that taxable profit is the profit or loss as computed in line with the provisions in the tax laws. Taxable profit is obtained by adjusting the accounting profits for tax purpose. Where you adjust your accounting profits, to get your taxable profit. Remember, your accounting profit will be provided. This will be provided from your financial accounting. It will be provided from your income statement. So the accounting profit will be provided in the income statement. So you now adjust your accounting profit to get the taxable profit. Note there are some items that will require adjustments to get your taxable profit. Number one, we have the expenses that have been charged in the account but which are not allowable as deduction for tax purposes. Number one item that will require adjustment or that will need to be adjusted in accounting profit to get your taxable profit, we have number one, expenses that have been charged, in the account, but which are not allowable for tax purpose. These expenses, they have been charged, they have been deducted in the statement of profit or loss, but the tax law does not accept those expenses to be deducted, so we call them non-allowable expenses. Non-allowable expenses. Number two, we have those expenses which have not been charged in the account, which are allowable for tax purpose. These expenses, they are acceptable as deduction for tax purpose, but they have not been charged in the income statement. They have not been charged in the financial accounting. They have not been charged in the preparation of statement of profit or loss. But the tax law accepts these expenses to be deducted. So we have allowable expenses not reported in the account. We call them allowable expenses not reported. But number one, they are not allowable expenses that have been charged in the account, but which are not allowable for tax purpose. These are non-allowable expenses reported in the account, while expenses which have not been charged in the account, which are allowable for tax purpose. These are allowable expenses not reported in the account. Then we also have taxable income not reported in the account. These expenses, these are incomes rather. This income are taxable in the hands of the recipient, but they have not been included as part of the income shown in the statement of profit or loss. That means this income, they are taxable, but they have not been included in the net profit figure. So we call them taxable income not reported in the account. Then we also have non-taxable income reported in the account. This income, they are not acceptable for tax purpose. They are not taxable, but they have been included in the net profit figure as reported in the account. We call them non-taxable income reported in the accounts. So all these items will require adjustment in the accounting profit to get the taxable profit. I said to get your taxable profit, you will need to adjust all these items. You adjust them in your accounting profit in order to get the taxable profit. Now, back to adjusted profit. Adjusted profit. Adjusted profit. Adjusted profit. You know, to get your profit or income will be derived from two variables. Adjusted profit, that will be to get your income, to get your profit, you net your expenses. You have income less expenses. Income less expenses, that will give us profit. Profit is difference between the income and expenses. So income less expenses, that will give us the profit. This income will be categorized into two. We are going to categorize our income into two. We have the taxable income and non-taxable income. Now, taxable income are those income that can be taxed. Those income that the tax law accepts for tax purpose. Meaning that this income, they can be taxed in the hands of the recipient. Non-taxable income, these are income that cannot be taxed. That is, the tax law does not accept them for tax purpose. That means they should be excluded in the tax computation. And the expenses can as well be divided into two. We have the allowable expenses and non-allowable expenses. Allowable expenses and non-allowable expenses. Taxable income can further be divided into two. Taxable income income reported in account. These are taxable income that have been included in the income statements. That is, they have formed part of the net profit that is reported in the statement of profit or loss. Then we also have taxable income not reported in the account. This income can be taxable in the hands of the recipient, but they have not formed part of the net profit figure reported in the statement of profit or loss. That is, they are not included in the net profit figure reported in the income statement. Then we also have not taxable income. Not taxable income can as well be divided into two. I said that can be divided into two. We have not taxable income reported in the account, not taxable income reported in account, and not taxable income not reported in the account. Remember, I've told you that not taxable income. I said these are income that cannot be taxed in the hands of the recipient. In the hands of that income earner, this income cannot be taxed in accordance with the tax law or tax provisions. So, not taxable income reported in account. This income cannot be taxed, and they have been included in the net profit figure reported in the income statement. Then we also have not taxable income not reported in the account. This income cannot be taxed, and they have not been included in the net profit figure reported in the income statement. So now we have allowable expenses. These expenses can be deducted from the income to arrive at the taxable income in accordance with the tax law or tax provisions. So these expenses, we call them allowable expenses. They are admissible. These expenses are admissible for deduction in line with the tax law or tax provisions. These expenses can as well be divided into two. We have the allowable expenses reported in the account. Reported in account. Remember, I told you that these expenses are admissible for deduction. They are acceptable for deduction, and they have been reported. That means they have been deducted in arriving at the net profit figure reported in the income statement. Since they have been deducted, so that means they have been deducted in arriving at the net profit. Then the second one is allowable expenses not reported. Allowable expenses not reported in the account. These expenses are acceptable for deduction, but they have not been deducted in arriving at the net profit figure reported in the income statement. So we call them allowable expenses not reported in account. Then we also have non-allowable expenses. Non-allowable expenses are those expenses that are not admissible. They are not admissible. They are not acceptable for deduction in accordance with the tax provisions. These expenses are not to be deducted when you are preparing your tax or when you are computing your tax payable or tax liabilities. These expenses are not admissible for deduction in accordance with the tax laws. And these non-allowable expenses can be divided into two. Non-allowable expenses, non-allowable expenses reported in the account. Reported in account. Meaning that as at the time of preparing the income statement, these expenses, they have been deducted. They have been deducted and they are not admissible. They are not acceptable for deduction in line or in accordance with the tax law. Then we also have non-allowable expenses not reported in account. These expenses are not acceptable for deduction for tax purpose and they have not been included in the income statement. They have not been charged in the income statement. So now, how should each of these items be treated? I'm starting with taxable income reported. Now, there are two methods of preparing the adjusted profit or of computing the adjusted profit for tax purpose. So when you are starting with the net profit figure, the taxable income reported in account. Remember, this income have been included in the net profit figure. And since they have been included in the net profit figure and they have been reported, so you ignore this. You ignore this. This should be ignored. They are already form part of the net profit, and if you add it to the net profit again, that will amount to double counting. So that should be ignored. Then taxable income not reported. This income, they are taxable in the hands of the recipient, and they have not formed part of the net profit figure. So since they are taxable, and when you are computing your tax, you are going to add this to your net profit. This should be added. It should be added. Then not taxable income. I remember I told you that this income are not taxable in the hands of the recipient. We said not taxable income reported in the account. Since they are not to be taxed and they have been reported in the account, that means they have formed part of the net profit figure. Since they have formed part of the net profit figure, so and they are not to be taxed, you are going to deduct that from our profit. Deduct this when you are computing your adjusted profit. Now we also have not taxable income not reported. This income are not to be taxed in the hands of the recipient. The tax law does not accept them to be included in the profit, and they have not been reported in the account. Since these have not been reported, that means it have not formed part of the net profit figure. Since it have not formed part of the net profit figure and they are not taxable, so this should be ignored. This should be ignored. Then we also have allowable expenses. We said allowable expenses, these are expenses that the tax provisions accept for deduction. These expenses can be charged in arriving at the taxable profit in accordance with the tax law or tax provision. And since they have been reported in the account, these have been reported in the account, we don't need to charge them further, because if you charge them again the second time, since they have been deducted already, that will amount to double counting. Therefore, this should be ignored. It should be ignored. So we also have allowable expenses not reported in the account. So these expenses are admissible for deduction in accordance with the tax law or tax provisions, and they have not been charged in arriving at the net profit figure. Since they have not been charged, therefore this should be deducted. It should be deducted when you are computing your adjusted profit. Not allowable expenses. We said these expenses are not admissible for deduction in accordance with the tax law or tax provision. Now we have no allowable expenses reported in the account. Since they are not acceptable for deduction in accordance with the tax provisions and they have been charged, they have been deducted in arriving at the net profit. That means the net profit have been reduced by these expenses, and the tax law does not accept them to be charged. So you add them back in order to increase the profit back to what it ought to have been if these expenses have not been charged. Then We also have non-allowable expenses not reported in account. Remember, these expenses are not acceptable for deduction and they have not been deducted in arriving at the net profit figure reported in the income statement. Since they have not been reported, that means they have not been deducted earlier, and the tax law does not accept these expenses to be deducted. So you are going to ignore this. This should be ignored. This should be ignored. So, methods of preparing adjusted profit or taxable profit. There are two methods of preparing the adjusted profit. Now, number one method is when you are starting with methods of preparing adjusted profit or preparing adjusted profit. The first method is when you are starting with the net profit figure reported in the account. And the second method is when you are starting with income or taxable income. When you are starting with taxable income. These are the two methods. I'm going to consider the first method in this video, while the second method will be considered in the next video. So I want to start with when starting with the net profit reported in the account. So when starting with the net profit reported in the account, you have XYZ Limited. Computation of adjusted profit for 22x year of assessment. So now you start with net profit. Net profit as per account. That is the net profit reported in the income statement. The net profit reported in the statement of profit or loss. Now, let's consider the treatment of each of the items. We said taxable income reported in account, we said this should be ignored, since it has already formed part of the net profit figure. Then we also have taxable income not reported in account. I said this should be added. You add taxable income not reported in account. Not reported in account. Since the profit hasn't formed part of this net profit figure, so that is why we are adding that. We said not taxable income, we said this should be deducted. Not taxable income reported, we said this should be deducted. Then not taxable income not reported, we said this should be ignored. Allowable expenses reported, we said it should be ignored. Why allowable expenses not reported, we said it should be deducted. We said non allowable expenses reported in account, we said we are going to add that. So we add non allowable expenses reported in account. We add that. So when you add, you have this as the total. You add it to the net profit at the top. So you have the total. You now less. You less these items. Number one, non taxable income reported in account. The non taxable income. We said this income cannot be taxed. Since they have been reported in account, that means this income have formed part of the net profit figure. It has formed part of the net profit figure. That is why we are going to deduct that. No taxable income reported in account. No taxable income reported in account. So we less it. We said allowable expenses not reported in account. We said this should be deducted as well. Allowable expenses not reported in account. So we deduct this. These are the items that should be computed and that should be considered in the computation of adjusted profit. So when you less this, you arrive at the adjusted profit for tax purpose. Adjusted profit for tax purpose. That is for method 1. Then method 2. Method 2, you start with taxable income. Taxable income. Taxable income, the one reported in account and the one not reported. You aggregate that. You now less allowable expenses. Expenses reported in account and the one not reported. Then when you less that, you arrive at the adjusted profit. So these two methods will give you the same result. The two methods will give the same results. Before I take a work example, I would like to consider the list of non-allowable expenses. Non-allowable expenses. I want you to know that for expenses to be allowable for tax purpose, it has to obey the Muren principle. The first W stands for wholly. R stands for reasonably. E stands for exclusively. And N stands for necessarily. For expenses to be allowable for tax purpose, such expenses must be wholly, reasonably, exclusively, and necessarily incurred for the purpose of generating revenue. Any expenses whose motive is not to generate revenue are not allowable for tax purpose. After that, allowable expenses must be wholly, reasonably, exclusively, and necessarily incurred for the purpose of generating revenue. Meaning that allowable expenses are usually a revenue item. Allowable expenses, they are usually revenue expenditure. Revenue expenditure. Meaning that capital expenditure are not allowable for tax purpose. The list of non-allowable expenses include number 1, depreciation. Depreciation is not allowable for tax purpose. Depreciation is an accounting derivative. depreciation. No, let me say non-cash items. Non-cash items such as depreciation, amortization, impairment loss, loss on disposal of an asset or non-current assets. These items are not allowable for tax purpose. Number 2, we have capital expenditure. Capital expenditure. Any expenditure that adds to the value of the existing asset, or expenditure that involve acquisition of non-current assets, then disposal of non-current assets, or expenditure that will improve the existing assets. Those expenditures are said to be capital items. They are not allowable for tax purpose. Number 3, general provision. General provision for bad debts. General provision for bad debts are not allowable, but specific provision are allowable. In case you are given provision for bad debts, just know that it is general and that provision is not allowable. But bad debts written off is allowable for tax purpose. Don't confuse your bad debts written off or your bad debts with provision for bad debts. Provision for bad debts are not allowable. General one is not allowable, but the specific provisions is allowable for tax purpose. Any contribution to unapproved pension and provident fund and provident funds, the one that is not approved, unapproved ones are not allowable for tax purpose. Then we have fines and penalties. Fines and penalties. Fines and penalties are not allowable for tax purpose. Then we have income tax provisions. Income tax provisions. Income tax provisions are not allowable. Pre-operational expenses. Pre-operational expenses or preliminary expenses. Preliminary expenses are not allowable for tax purpose. Then we have any sum recovered from insurance company. Sum recoverable from insurance company are not allowable for tax purpose. We have appropriation of profits. Number 9, we have appropriation of profits. Appropriation of profits in form of dividend paid or proposed. dividend paid or dividend proposed are not allowable. Transfer to reserve. Transfer to reserves is not allowable. Even general reserves. General reserves or reserves in whatever form, they are not allowable for tax purpose. Number 10, we have donations to unapproved bodies. Donations to unapproved bodies are not allowable for tax purpose. Number 11, we have legal fees. Please, to learn more on donation to unapproved body, go through your study test and go to find out the list of the approved bodies. Legal fees. Legal fees. Cost of acquiring a new lease. Legal fees are not allowable. Any cost of acquiring a new lease, that is legal costs or incur in acquiring a new lease, are not allowable. Costs of renewing a long-term lease are not allowable. Cost of defending a traffic offense. Cost of defending a traffic offense are not allowable for tax purpose. Then we may also have cost of tax appeals. Cost of tax appeals. Cost incurred in appealing to tax authority. Cost of tax appeals. They are not allowable. Stamp duty on increase in share capital. Stamp duty on increase in share capital. All these costs are not allowable for tax purpose. Now, we also have non-taxable income. Non-taxable income. Non-taxable income. We have profits from disposal of PPE, property, plant and equipment. 2, profit from sales of investment. All these income are not taxable in the hands of the recipient. Having examined the list of non-allowable expenses and the non-taxable income, we therefore want to take a work example. Example: Mohammed Limited has been in business for many years and makes up accounts to November 30 annually. The income statement contains the following for the year ended November 30, 2021. We have gross profit of 1,230,936. Miscellaneous income 31,440, and total income is 1,262,376. We have salaries and wages 251,240, Electricity and other utilities 19,260. Rent and rates 145,080. Repairs and renewals 40,920. Motor vehicle expenses 130,140. We have depreciation of 171,300. Interest and bank charges of 21,120. Bad and doubtful debts 40,540. Miscellaneous expenses of 44,840. Legal and professional charges 30,900. Pension contribution employers 38,240. Audit fees 34,400. Donations and subscriptions 37,200. Directors' emoluments 36,000. The total of all the expenses is 1,047,180. After all the expenses have been deducted from the income of 1,262,376, we have the net profit to be 215,196. Net profit 215,196. Now, you are given the following additional information. A. Bad and doubtful debt figure consists of 1. General provision 12,000. 2. Specific provision 27,100. 3. Bad debts written off 6,500. 4. Bad debts recovered 5,060. B. Defalcation and embezzlement. A director defrauded the company to the tune of 40,000 naira. The other embezzlement were committed by junior staff. C. Miscellaneous income includes profit on disposal of property, plant and equipment 8,690. D. Legal and professional charges include 1. Debt collection 6,000 naira. 2. Renewal of short leases 2,400 naira. 3. Defense for traffic offence 1,500 naira. 4. Land acquisition 15,000 naira. 5. Retainership fee 6,000 naira. E. Miscellaneous expenses comprise 1. Court fines 2,400. 2. Exchange loss on translation of intercompany balances 25,140. 3. Exchange loss on remittance 6,500. 4. Office expenses 10,800 naira. F. Donation and subscription comprise 1. Lagos Chamber of Commerce 3,000 naira. 2. Motor Boat Club 1,200. 3. Polo Club 1,000 naira. 4. Political parties 30,000 naira. 5. National Relief Funds 2,000 required. Compute adjusted profit for the relevant assessment year. That is the question. This question is obtained from the study text of the Institute of Chartered Accountants of Nigeria, Ican Advanced Taxation. Solution. Now, the name of the entity is Mohammed Limited. And the year end of Mohammed Limited is November 30, 2021. And since the year end is 2021, I mean the accounting period or the accounting year is 2021. That means the income for 2021 will be assessed in 2022 on preceding year basis, PYB. So the income for 2021 will be assessed in 2022 year of assessment. So you write the name of the entity, Mohammed Limited. Computation of adjusted profit for, the accounting year of Mohammed Limited is 2021. So it will be assessed in 2022 as I've said earlier. If you look at the requirement required, compute adjusted profit for the relevant years of assessment. If you put computation of adjusted profit for the relevant years of assessment, you will be scored 0. No single mark will be awarded to you. Examiner will be interested in you identify the year of assessment. So do not put for the relevant year of assessment. That is for examiner. It is the examiner that will put relevant year of assessment, but you have to mention that year of assessment. Otherwise, failure to mention the year of assessment, everything you are going to do will amount to 0. So computation of adjusted profit for 2022, not 2021. The accounting year is 2021, which will be assessed in 2022. If you put 2021, you will equally score 0. Computation of adjusted profit for 2022 year of assessment. Another word for year of assessment is the tax year. If you don't want to put year of assessment, you can put the tax year. Then you start with net profit, and if it is loss, you also start with that. Loss in braces. Net profit as per account. Now, the net profit of Mohammed Limited is 215,196. 215,196. Now, if you go through the additional information, I said you are the taxable income, not previously reported, and there is no taxable income not reported in this question. I currently said you should add the non-allowable expenses previously reported. Now let's go through the additional information to identify the list of non-allowable expenses that have been reported in the financial statement. Note A. You were told that bad and double debt figure consists of, if you look at the income statement, you see the bad and double debts there. The bad and double debts is 40,540. We were not given the breakdown of the bad and double debts here. That is the breakdown. We were told that it consists of general provision. Remember, I've told you that the general provision is not allowable. So that means the 12,000 will be added back to the profits since it is not allowable. I told you that specific provision is allowable and bad debt written off is allowable. Bad debt recovered is taxable. So that means the only expenses that is not allowable, which have been included in the income statement, is the general provision of 12,000 naira. So we now add non-allowable expenses reported in account, and among those expenses we have general provision for bad and doubtful debts. General provision for bad debts, which amounted to 12,000 naira. 12,000 naira. B. Depreciation and embezzlement. A director defrauded the company to the tune of 40,000. The other embezzlement were committed by junior staff. If you check the financial statement, you will not see depreciation and embezzlement anywhere. Remember, depreciation and embezzlement is not allowable. That means depreciation and embezzlement, the amount is not allowable expenses. Now, if you check your income statement here, go through the list of expenses, salaries and wages, electricity and other utilities, rent and rates, repairs and renewals, motor vehicles expenses, depreciation, interest and bank charges, bad and doubtful debts, miscellaneous expenses, legal and professional charges, pension contributions, employers, audit fees, donations and subscription, directors emolument. There is no depreciation and embezzlement anywhere in the income statement. That means depreciation and embezzlement is not allowable expenses, not reported. It is not recorded in the income statement. That is why we say it is not reported. The expenses is not allowable and it is not reported. I told you that for non-allowable expenses not reported, that you are going to ignore that. So that means the no B will totally be ignored. Now C. Miscellaneous income includes profit on disposal of property, plant and equipment. I told you that the profit on, when I was considering the non-taxable income, I made mention of profit on disposal of property, plant and equipment. Profit on disposal of PP, I said it's not taxable. That the non-taxable income which has been included. If you check your income statement, you will see miscellaneous income there. Let's check. Miscellaneous income 31,440. So that means it is not taxable income reported in the account. This income is not taxable and it has been included. It has been reported in the account because it has been included in the miscellaneous income. It is not taxable. Therefore, you are going to less that. I've told you that not taxable income previously reported in the account that you are going to less that. So let's leave that if we identify those things to be added first. Now, we have and professional charges include debt collection. You check your income statement. Do we have any item like legal and professional charges? So in our income statement, we have legal and professional charges of 30,900. 30,900. And you were told that legal and professional charges include these items. Debt collection. Debt collection is allowable. Since it is allowable, that means the 6,000 will be ignored. That means it is an allowable expenses reported in the account. So we don't need that. That should be ignored. Renewal of short leases. That is also allowable. Defense for traffic offense. This is not allowable expenses reported in the account. Since it has been included in legal and professional expenses, which shall be charged in the statement of profit or loss, that will show that this is not allowable expenses reported in the account. So we are going to add that defense for traffic offense. Now, defense for traffic offense, and that amounted to 1,500. 1,500. We also have land acquisition, which amounted to 15,000. The amount spent on land acquisition is a capital expenditure. And I've told you that all capital items, all capital expenditures are not allowable. So we are going to add that. This is not allowable expenses reported in the account. Land acquisition of 15,000 naira. Then we also have retainership fees. Retainership fees is allowable. So allowable expenses reported in the account, that should be ignored. Note E, miscellaneous expenses comprise. Do we have anything like miscellaneous expenses in the income statement? Now, if you go through your income statement, you will see the miscellaneous expenses of 44,840. Now, back to the note. Miscellaneous expenses comprise court fines. This court fine is not allowable and it has been reported in the account. So this is not allowable expenses reported in account. Court fines, that is 2,400. Court fines. Court fines of 2,400 is not allowable. Then we have exchange loss on translation of intercompany balance, 25,140. That is not allowable as well. Exchange loss on translation of intercompany balance, and that amounted to 25,140. 25,140. Then we also have exchange loss on remittance. This is allowable. Office expenses is equally allowable. Then note F. Donations and subscription comprise. Now let's go through the income statement to know if you have any item like donations and subscriptions. Income statement. We have donations and subscription 37,200. And we were now told that donations and subscription comprise Lagos Chamber of Commerce. This is among the list of approved body. I've told you that to know the list of approved body, you go through your study test to ascertain the list of approved body upon which donations can be made. Any donation given or granted to any of the approved bodies is allowable for tax purposes, while donation to unapproved bodies are not allowable. Lagos Chamber of Commerce is one of the approved bodies, so that donation is allowable. Motor Boat Club is not among. So donation to Motor Boat Club. Donation to Motor Boat Club, that amounted to 1,200. 1,200. That is not allowable. Then we have Polo Club. That amounted to 1,000. Donation to Polo Club of 1,000. Then donation to political parties. That is 30,000. Political parties. 30,000. Then we have National Relief Funds. That is allowable. National Relief Funds is one of the approved body upon which donation can be made. So that is an allowable expenses previously reported. Therefore, that should be ignored. Now, let's go through the income statement to see if there is any item reported in the income statement that is not allowable for tax purpose. Salaries and wages is allowable. Electricity and other utilities is allowable. Rent and rates is allowable. Repairs and renewals is allowable. Motor vehicles expenses, all the items listed, they are revenue expenditure, they are allowable. Depreciation, I've told you that depreciation is not allowable for tax purpose. So now let's have our depreciation. Depreciation 171,300. 171,300. So you now sum up all this. 12,000 plus 1,500 plus 15,000 plus 2,400 plus 25,140 plus 1,200 plus 1,000 plus 30,000 plus 171,300. That is total 259,540. If you add it to the 215 plus 215,196, then you have the total of 474,736. 474,736. Now, when we're going through the details, the footnote, note C, we said this is not taxable income reported in the account. Profit on disposal of PPE of 8,690. We say it's not taxable. So we now less not taxable income reported in account. And the not taxable income reported in account include a profit from disposal of property, plant and equipment of 8,690. So we have profit from disposal of PPE, which is 8,690. If you deduct that from the total we had above minus 8,690, then you have 466,046. This is our adjusted profit for tax purpose. Adjusted profit for tax purpose. This is the end of part 1. In part 2, I will also use the same question, but I will use the second method where we have allowable expenses, the one reported plus the one not reported. Taxable income, the one reported and the one not reported, minus the allowable expenses, both the one reported and the one not reported in the account. So I will use that second method to solve the same question. Thanks for watching ACCA.